All right. Thank you. Very glad to see everyone join us today. So thank you. Today we have a very special topic. At Synctera, we see fintechs and banks every day, right? And they face the same challenge of trying to balance between growing quickly, meeting customer expectations, staying compliant. So now what we're going to focus about today is around fraud, because fraud is usually thought of more as a cost center, right? Something you try to minimize your time spent on. But we're here today to kind of flip that script. And we'll be exploring how a smarter fraud strategy can actually help us enable growth, strengthen your customer trust, and unlock scale for the business. Now, this is very critical for us, especially in the days of fintech in 2025. Everything's really being shaped by like three big forces, right? You have the customer expectation for like seamless, fast experience going on one side. We have a lot of intensifying like regulatory scrutiny. And of course, I think AI create a new threat metrics that is introduced into the entire ecosystem. So as quickly as any of us within the innovation space are embracing AI, our bad actors on the other side are exploiting it just the same. So the question that we all have to balance is how do you stay ahead, right, while continuing to grow? So that's exactly why, Rishi, I'm super excited to welcome you to the session today. Rishi brings nearly 30 years of experience in financial services and risk management. He's led product and strategy team across fraud, compliance, payment, and analytic from company like Equifax, Fiserv, Vista. And today he's helping large institution and banks stay ahead of a lot of this evolving threat as part of his leadership role at Hawk. So, Rishi, welcome to the session. Thank you for joining us. And with that backdrop, let me hand it over to you.
Thank you, Ellen, and good afternoon, good morning, everyone from wherever you're joining. So, very interesting topic, but let's really set the stage of what Ellen just mentioned, the ever-evolving payments landscape that we are all seeing right now. Digital payments are becoming more and more relevant. Less and less cash and checks are being used, even though we keep saying checks are going away, cash is going away. It's never really going to happen, in my opinion. But we're seeing all these new alternative rails and embedded payments and wallets starting to take more and more prominence within every interaction that we're doing, whether it's interacting consumer to business, or business to business. So what happens is your traditional payment methods have this new competitive angle that has suddenly shown up. And people are now starting to use these alternative payment methods and these alternative payment rails to just interact and transact like we used to in the old days. But it's very important for us to understand what has really driven this change, because it started off a couple of years ago and now it's just becoming more and more prevalent everywhere we go. The key thing that Ellen touched upon is consumer demand. As a consumer, I want to see things done faster, easier, instantaneously, and on the go. I don't have the time to sit down and spend 10 minutes if I'm trying to have a transaction with a business, whether it's a utility company or a merchant, or even send money to my friend. I need to be able to do that on the go. So that's a key driver to some of this change. The other driver to the change has also been the way markets have shifted. We are in a constantly changing, ever evolving economic condition across the world. And so what's happening is consumers are preferring to use these alternative payment methods because maybe I cannot go get a credit card for one reason or the other. Maybe I don't want to have large deposits sitting within a bank. I want to be able to do something very quickly and instantaneously. And of course, I'm using my phone, my watch, or any other digital tool that allows me to do that as quickly as possible. But we all know when new technology comes in, when new methods come in to interact and transact, so does new angles of fraud. And we keep talking about AI. We're going to cover some of that in more detail. But we have to realize that AI is being used by fraudsters as much as it is being used by people that are trying to prevent fraud. So we keep hearing these new fraud vectors that pop up. Everyone, I'm sure, has seen videos of deepfakes where I can show up on a video screen looking like someone completely different with a different voice. that circumvents some of the traditional checks that are in place, where people take pictures of IDs and faces and send them to a bank or an FI to identify that they are who they say they are. New synthetic identities are being created, people that appear to be real and show up in every validation that occurs, but they're not really real. They're manufactured by combining elements of people's identities. Phishing attacks are getting more advanced. People know more about you because we're posting things about ourselves on social media. And so when someone reaches out to you about a certain incident that happened yesterday, most of us will fall for it. Automation continues to expand even by fraudsters as much as people that are trying to prevent fraud. And so what happens is some new topologies start to appear. Now, let me explain what that word topology means. It really means categorization of a type of tactic that is used by a fraudster to commit fraud. A common example of that could be someone trying to do a scam, impersonating somebody that you know. It could be new account fraud, where I've been able to construct pieces of information and put them together and passed every KYC check that's in place today. Or it could be an account takeover. Very simply, I know that your password is not very strong, and I was able to come and take over your email address. And now I'm able to use that to log into my FI or bank account. And now I'm impersonating you and being able to do what I want. The other key driver for change is just the ever evolving regulatory environment that we are in. Initially, it used to be limited primarily to banks and FIs, but now non-banking FIs are also getting subject to new regulation day in and day out. So it's really important that as all of these elements are evolving, that you have to have the right fraud strategy in place to be able to meet all of these needs and demands, whether they're regulatory, whether it's around fraud mitigation and prevention, or whether it's around consumer behavior and experience.
Yeah. And Rishi, I love that we're covering all this three topic, especially since I think the combination of the business that we see is both business account, consumer account, right? International account, domestic account. I'm sure there's a little bit of like fraud topologies that varies and that you guys have seen differing based on who we're serving and the kind of audience that each of this fintech are solving for as well. So it would be super interesting to kind of touch on some of that and learn more. But this is great.
Absolutely. Next
Yeah.
slide, please. So now let's really understand the strategy behind how do we make sure we have the right fraud tools in place to be able to meet all the needs across all these three vectors that we just discussed. The underlying core problem is that there's no silver bullet. You can't just go and deploy something and say, okay, I have completely mitigated fraud because unfortunately, I don't believe there's a solution that says if you put it in place, there'll be zero fraud. It's all about figuring out what the right balance is. So I always talk about fraud prevention as a balancing act. If I go towards too much friction, too much risk averseness around my fraud strategy, I'm going to create a lot of consumer friction. Consumer friction means the experience is going to be very bad. Consumers might choose to go somewhere else if they feel like they have to jump through hoops to even do the most basic thing. On the other side of the spectrum, if I offer the most seamless and easiest consumer experience, then I'm exposing myself to a lot of fraud. There are fraud losses, but the other key thing here to remember is fraud losses come with reputational risk to the institution and also comes through regulatory exposure. Because if you have too many losses, regulators start thinking about, do you have the right fraud controls in place? And I'm sure you guys have heard of some of the brands and logos that have been in the news over the past 12 months that have gone through that scenario. So really, it's all about figuring out where the right balance is and using that as really a strategic tool. Now, friction by itself is not really bad, but if you put it in the wrong place, that's when it creates a problem. It prevents you from being able to do basic transactions. It hurts you from an acquisition perspective. And these days, if you just put your consumer hat on to do something, there's so many different options available. So you'll always lean towards going to a brand or a logo that gives you the most seamless experience, but also keeps reminding you that they have controls in place. That's when, as a consumer, I feel my money is safe with this institution. I would not have to worry about going through hoops if something bad happens, and they're giving me the best experience possible. So, when you start putting that in control, obviously within an institution, everybody looks at that particular angle from a very different point of view. So let's look at the three most common personas that exist within an institution and see what they really care about. So if I own a channel, if I'm the business owner, if I own a product, let's say I own a bank account or I could even own a credit product. My goal is always going to be to prioritize growth, to provide the most seamless customer acquisition through the least amount of friction. But I'm also going to expect that there are some fraud controls in place, but not at the expense of creating too much friction for my consumer. Because I want to acquire, I want to retain, I want to drive usage. Because as that channel owner, as that product owner, that's how I make money. If you go to the other side of the spectrum and your core responsibility is managing the risk within the institution, your goal is to make sure that you have the most stringent controls possible because you're measured against how many fraud losses you have. So you will always be focused on that. You'll always be focused on making sure you have the right trails because you don't want any regulatory exposure either with the fraud losses. And you will be okay if there is friction as because the core focus of that friction is to mitigate risk. You're not too much worried about acquisition. You're not too much worried about retention. You're not too much worried about usage. And then sitting in the middle, where I think a lot of the balancing act comes into play, is someone that's accountable for the infrastructure, the workflow, the end to overall experience, and how the institution is able to pull in both perspectives, whether it's the channel perspective or the risk perspective, into a workflow that provides it in a seamless way to a consumer. So you'll always be looking at seamless integration. You'll always be looking at scalability. You'll always be looking at efficiency. If you're plugging in a fraud control or a risk control into the system, you'll be wondering how that changes the overall workflow and can I scale it across the board? What you don't want is adding a risk control and creating 10 additional steps for the consumer because it defeats the purpose for both sides of the equation.
And Rishi, like in that context, right? Like if it's really about like where some of this friction should be introduced, it's not just what friction is being introduced, right? Like I'm curious if you have sort of kind of suggestion on who should own those fraud rule tuning and refinement and setup, right? Because it's balancing between sort of kind of compliance team, business owner, CTO. I'm thinking sort of kind of some sort of like product technology team. Have you seen best practices of how organization can actually balance where the rule definition sits to take all those into account?
Yeah, I mean, it boils down to in my perspective, I've seen sort of the channel owner owning that from an
Mm.
overall outcome perspective, but it's never really one person's accountability or responsibility. It's always coming to the table with all the stakeholders and making sure that their core objectives that they're being measured against are being met as you're sitting there and doing that balancing act between friction and ease of use. And that actually is a great segue into the next slide, because really, to Ellen's question, how do you align your fraud prevention strategy to the overall business objectives? And as we saw across the board, we just looked at three personas. I'm sure there are more. Each one of them is interested in making sure that whatever strategy you deploy is meeting their specific business goals. So it's really important to understand what those business goals are. And we'll touch again, going back to the three personas, what their business goals could be. but the key is identifying those so you find the right balance. You then look at your fraud risks, your exposure that you have, or the risk that you're able to take, and you map those to those objectives. And we'll dig in a little bit more about that again as we go through. Once you've mapped those risks, to mitigate those risks, you have to have the right fraud controls in place. So you apply or choose the right fraud controls. It could be something that you have, something you build, or something you go partner with a vendor to bring in. But now you've done the mapping, so all of your risk exposure has been covered. You then embed that into your existing workflow, right? So whether it's an account opening process, whether it's a login process into my particular product, it's how I use my product through an app or on the web. You now start doing the mapping to make sure across every touch point, across every workflow, you've been able to plug in those risk controls in place. You then monitor and see, are these risk controls that I have put in place giving me the outcomes that I care about? And this is really, really important because this is not a one-time thing. I can't go put a risk control and then wipe my hands off and say, I'm done. It's all about measuring, tuning, and going through that cycle over and over again. Because again, as we know, fraud is an ever evolving thing as well. Fraudsters are not sitting there trying one thing, and if it doesn't work, they go back to doing something different. They're constantly finding ways of circumventing controls in place to get in and commit fraud and leave as quickly as possible. So it's important to have those measurements in place and tune them on a constant basis. And then, of course, as I mentioned early, you could have one person or one persona accountable for the overall outcome, but it's always a group-based decision. All the stakeholders have to come into place together and identify, are these controls giving us the objectives that we are being measured against? That's what drives a healthy fraud prevention strategy within a bank or an FI.
And I love that. I think too often we actually see a little bit of like the foreman drill, set it and forget it kind of approach, right? Where I think early in engagement, there's a lot of attention and focus on the initial business objective. But I love the suggestion to focus on this as a continual effort, right? Like the ability to come back, revisit, and make sure it's still relevant and to adjust as necessary.
Sure. Yep,
Yeah.
absolutely. Next slide, please. So now let's dig in a little bit more into aligning these business goals and the fraud metrics, right? And as you can see, based on the persona that you have within an organization, each one of them looks at their business goals and the metrics in a very different way. If I'm a channel owner or a business owner of a product, I always view fraud controls as a potential roadblock because fraud controls create friction. I'm always thinking about ensuring that I have controls in place, but with the least amount of friction, because that is what is going to drive growth within my product. That's what's going to help me from a retention perspective within my product. If I'm a risk officer, my focused priority is to make sure I have the right level of defenses in place to mitigate fraud, to prevent fraud. I have the right audit controls in place and I have the monitoring in place because I have to show that these controls are actually driving the metrics that I care about. You then use that audit layer to also be available for any sort of regulatory alignment that may happen. Because when fraud happens, it's not if, it's when. Can you have the right trails in place so you can protect your reputational and regulatory exposure as and when you get questioned about what controls you had in place? If you're a CTO, you're basically looking at fraud prevention as a key component of your overall platform, of your infrastructure health, because everyone's using that platform to drive usage, drive growth. So you're ensuring that all of that stuff is in place so your platform can actually scale over time, whether it's regionally, nationally, or globally. So To me, the way I think about fraud prevention, like it really again comes down to an overall business strategy. Just by looking at these three personas within an organization, we saw that each one of them is looking at it from a very unique angle. But when combined together, it really becomes a business enabler. It really drives growth. It really prevents you from being exposed to regulatory exposure or risk or reputational exposure. So if you combine all of these together, that's where I think you can drive the value and the growth within the organization, irrespective of the persona or the role you have within the organization. And underlying to me, the biggest thing always is, technology is always going to be the key. Because at the end of the day, these controls are getting plugged, getting embedded into your technology stack. And if you can do that in an effective way, then you have the right solution in place that's meeting everyone's business objectives and driving growth. Next slide, please. So now let's talk about the buzzword that everyone talks about when it comes to fraud, AI, right? Um, AI is really important and it provides a lot of value to all of the personas that we spoke about in its own unique way. So let's talk about how it does that. The key thing about AI is using that to spot known topologies with precision. So we spoke about typologies, the way people use scams and approaches to commit fraud, but using AI and using data, you're able to create models. These models can be used to detect these types of fraud that are being committed, and you can catch them in a very quick and easy way. Obviously, you have to make sure you train these models, you monitor their performance, you tune them over time, going back to our cyclic approach of tuning, measuring, and doing that over and over again. And then leveraging the data and the know-how of data science to make sure that these models are delivering the best possible outcome. Now, as an example, at Hawk, we came up with an approach that we call day one fraud models. The core idea behind that is we have created these AI models and trained them in a way that if we are able to get customer data, the behavioral information that's telling us some of the usage patterns, we can tune the model for a typology based on the consumer's data within 1 to 2 business days. And we call them day one fraud models. As many of you are aware, if you go out into the market typically and you're looking at a new fraud model, you're looking at 6 to 9 months from the time you engage with a model to make sure that you're feeding it the right amount of data before it starts giving you the most optimal outcomes that you care about. But leveraging AI and leveraging some of the modern techniques, you have an approach, an ability to do that within 1 to 2 business days, as long as you feed it with the right data. So that's where AI gives you that speed and scale and precision to do that very effectively.
I'm sure, Rishi, we're going to get a ton of like follow-up question on therefore what kinds of data we actually need to track and all this stuff.
Sure.
But
Sure.
I think the intentionality on the data collection is probably an important kind of takeaway to plan from the beginning.
Yep. Yep.
Yeah.
Absolutely. The other way you can use AI is to identify anomalies or what we call unknown new types of fraud or attack vectors that are coming in through the data. So what AI really allows us to do is it allows us to understand consumer behavior because each one of us interacts with an FI, with a bank in a very specific way. We have days of the week, days of the month, times of the day when we go in and we do certain things. They become part of our behavioral patterns. So if someone logs in at a time that they typically don't and interacts and does something different, it's okay if you flag it once, but being able to detect that over large volumes of data really allows you to detect these anomalies faster. And that's when AI comes into play and helps you do that as well. This becomes also very important if you have certain patterns within an FI that offers multiple products, because I could have a behavior with my bank, I could have a behavior with my card, I could have a behavior with my loan. but an anomaly that occurs in one of my products, that information could be leveraged across all of these products. Because if my account has been taken over, if a fraudster is impersonating me, very quickly and easily, you're going to start seeing them attempt to do the same thing across all the products that I have with the FI, because they have a very short window to do that. So, leveraging AI, we are able to detect some of these anomalies very quickly, and we're able to validate them because they could be genuine, or prevent access or prevent the transaction from going through because we know for sure that that is a fraudulent attempt on that particular account, on that product, by someone impersonating you. And the third use of AI, which becomes really important, is around false positive reduction. Now, going back to the personas, this probably impacts the channel owner the most, because to me, false positive is seeing a transaction, identifying it as fraudulent because you did not leverage the right amount of data and your models have not been tuned correctly, and you're identifying a good consumer as a fraudster. The most obvious outcome of that is enhanced friction for that consumer, and most likely the consumer is going to abandon the transaction and possibly abandon the relationship as well. So it's always ensuring that you're using AI to detect false positives, reduce them through tuning, through training, and then making sure you're leveraging that AI to provide that most seamless experience again. But sometimes it's okay to insert a little bit of friction. This happens to me all the time. I interact with a couple of banks and FIs, and every now and then they'll throw in some sort of a OTP challenge to me, and I'm okay to do that because I feel like my bank is protecting me. It
Yeah.
has controls in place, right? It's
It
not
actually
that
makes you feel more secure, right?
totally, totally,
Yeah.
right? And
Yeah.
that's what's really, really important.
Yeah.
Now,
And I think and Rishi, maybe talk a little bit about like kind of the like you said, like the customer expectation in that area, because it's there is a different level of friction expectation, I think, when it comes to financial product that consumer have, especially in the days of scams and everything else that, probably actually adds value and legitimacy to your own platform if provided and put in the right places, right?
yeah, I mean, as a consumer, I expect it, right? Like, even if I'm on my phone, if I happen to be in a different location, or I'm trying to interact with my bank at a non-traditional time that I do, as a consumer, I expect some sort of checks in place, right? It makes
Yeah.
me feel easy that my FI is taking care of my information, of my data, and most importantly, my money that I'm leveraging to transact. So that expectation comes into play really important. From a bank or an FI perspective, based on their personas, to me, that's when non-traditional stuff happens, going back to the anomaly detection stuff, they're leveraging that to see, hey, is this a unique type of fraud that's being committed? How do we ensure that we are managing our exposure, right? And if that means that, it's a false positive and I'm going to challenge the good consumer, so be it. Because I'm trying to minimize my fraud exposure. And the consumer in this scenario will actually also appreciate it because they'll feel like we have their protection in mind. So that's where I think that expectation comes into play. Now, there are a whole lot of different AI components that we hear about, like generative AI, large language models, agentic AI. We could probably have a webinar on that just by itself. But you can see how AI is becoming more and more prevalent across the board. Next slide, please. So, as we sort of summarize our discussion that we had today, the key thing is what do we think are the key components of having the best balanced fraud strategy in place? First thing is ensuring that you are having intelligence that's being driven by a data first approach. You can't sit there and make a decision based on just one segment or one piece of information, because it's very easy to make the wrong decision. And fraudsters will try and understand where you have your balances and checks in place. And if your data is just singular and one directional, they'll find a loophole to get through. So it's always bring all your data together, figure out how to use it. You could have transactional information, you could have usage information. You may decide to pull in external information. We hear about people leveraging device fingerprinting and behavioral because you could have shared devices within a household, but how one person uses the device is very different than the other person using the device. So those components need to be brought in to identify it's Rishi and not his spouse using their bank account because the exposure could be very different, right? Uh, Ensuring that you are also leveraging data across multiple accounts. As I mentioned, my usage for a bank account versus a card account versus a loan account, bring all that data in. That's really, really important. So you're driving intelligence through this data-led approach. Obviously, leverage AI. People talk about fraud controls with rules. Rules are never sufficient. Leverage the AI, bring it into play, and then deploy that across a technology stack that scales and drives efficiency and has the right audit controls in place so your regulatory exposure is minimized. And if and when fraud happens, you have the data to show that you had the controls in place and combine them all together and deploy it and then continue to tune it over time. That is where I think your fraud strategy is going to drive growth and it's not going to be focused on just pure fraud prevention. I'll end that with maybe an example that I have seen most recently at Hawk that might resonate. You know, we have a client, they deal with international payments and FX accounts, and what they realized is they were struggling to identify fake merchant accounts. They were using a platform. The platform was allowing them to create these fake merchant accounts and start scamming individuals that were sending money through that platform. With our day one fraud model, we were able to come in, we were able to get data, we were able to tune the model. And within a couple of business days, very quickly, we were able to identify 30% more fraudulent merchant accounts than their current tool was actually enabling them to do. And what that did is it reduced their overall fraud rate by almost 80% because these 30% merchant accounts, more than what they were catching, was really driving all of that fraud
Wow.
across individuals where money was flowing in and then the person would not get what they thought they were buying from this particular merchant, right? All
Yeah.
by leveraging the right tool, tuning it with the right data, having the right model, putting it into the right workflow, not creating additional friction for the individuals or even the fraudulent merchants, because we want them to get through sometimes to identify them and leverage their patterns. But we were able to do that in a very seamless way, very quickly. And that gave us amazing results for our customer.
That's awesome. And I think the intentionality in having the right set of data and information and planning end to end, like I think that's really insightful to think of like it's not technology alone, but the alignment of like different business players, right? Getting the right data, having the engagement of like a partner tooling and all those seems really critical and to be able to think of like fraud holistically. And like you said, like it's a competitive advantage if done correctly.
Absolutely. Absolutely. Spot on.
Yeah.
So I know we got a little bit over, but I'm open to any questions that folks might have. And I'm assuming, Ellen, if you're not able to get to all of them, we can still
Yeah.
take them down and then get answers back.
Absolutely, absolutely. So if folks have any question at all, go ahead and post them right now. We maybe have enough time to take on one question and then Rishi will share the remaining um question that we can't get to and we can send the follow-up to the teams. All right, so let me let me take the first question that we have here. All right. So as you guys are seeing fintech who are just getting started, right? And maybe just dipping their toes into fraud in general, like what are the most critical things that they should be doing to actually improve their fraud program? Like I think we had a question from the audience on more folks who are just stepping into this? Like, where do you start? Like, how do I improve my program?
Yeah, that's a great question, right? So the key thing is when you you create your fraud strategy, you align it to your business strategy and the goals, what you have to think about it is not as a cost center for the institution, but as something that prevents, that is basically a revenue protector for you. And then it also builds consumer trust because what it's going to do is it's going to deploy itself within the workflow, ease the use of signing up, ease the use of usage, prevent fraud. So you have to think about it as more like this is what I use to protect my revenue and not just something that's just preventing or mitigating my fraud losses by itself. You also have to make sure that whatever strategy you deploy in place gets buy-in from all of those stakeholders. So you saw that we covered the channel owner, the CTO, the risk officer, but there are other people in the organization that this particular tooling that you create, it has to align with their business goals. Start off with a fraud policy. You know it's not going to be static, fortunately or unfortunately. Assign someone that owns it within the organization and then figure out how you deploy this fraud strategy within your technology stack. Now, this is important because it needs to scale. It needs to be real time. We're talking about payments here, right? So they have to be real time. As the volume grows, the technology stack should be able to support it with these risk controls, with this tooling in place. Make sure that you can bring in data internally or externally that feeds your tooling to make the best decisions possible. And then leverage AI, continue to measure, tune over time so that as the data evolves, as the fraud patterns evolve, as new typologies come into play, you are leveraging the best of all of these components together to again drive the one critical goal you have, which is grow your revenue, protect your consumers, and minimize your regulatory exposure.
Awesome. Thank you. So I think that's all the time we have today. Thank you all for joining us. Thank you so much, Rishi, for sort of sharing your wisdom with us. I think really the key takeaway here is all the things that we've talked about brings in strategic cross-functional effort, the right tooling, the alignment of business, right? Like I think oftentimes just shifting the mindset of thinking of fraud as a something that you must do just for compliance purposes, and thinking about it not just as the what, but also the how and the where all of those fraud prevention are weaving in is critical to the business. This will help you protect your business while enabling growth. And what Rishi shared earlier on the consideration, if you are the CTO, if you're the risk officer, if you're in the business, and just understanding how various roles within the organization brings different perspective to it would really help take the business and the thinking behind fraud to the next level. So again, thank you for everybody's time. We hope that this leave you inspired to take your fraud prevention and compliance sort of kind of approach internally and use fraud as potentially a true business enabler for your own solution. Thank you.
I thank you, everyone. Bye bye.
Bye-bye.